Europe is about to go through a major energy crisis as we work our way through this winter. It really depends on the weather. But if we do get one, how much does that undermine the case for investing into European stocks, particularly industrials?
Yeah, I think there's been too much exuberance around the European equity story anyway, I think, because if we're quite honest, European equities performed well in Q1 and until the beginning of Q2. Why? Because yields globally went up, yield curve steepened, everyone wanted to have value. Where do you find value, which is, the most cyclical market across all the major global equity regions? Well, it's Europe, right? And as much as, we talk about peak everything at the moment, peak data, peak surprises, perhaps peak optimism as well, it's not really the time to go into European equities now. It's much more the time to hide out in growth and in quality at the moment. I think that's much more the way to go. And just, the stories about higher input costs, higher energy costs, that perhaps a bit of a drag to the consumer, that doesn't help either.
Well, Max, that's not going to help U.S. companies either. And U.S. companies are also potentially dealing with higher taxes, over a $2 trillion tax bill just got through the House Ways and Means Committee here in the U.S. Plus, there's the midterm elections coming up in 2022 that's going to make everything pretty messy. And it does feel like U.S. could be closer to earnings downgrades than Europe.
I'm not quite sure. I think what we will need for European, for European earnings to be upgraded relative to the U.S. is really a big tailwind from the euro. So we will need really quite a sharp depreciation of the euro. That doesn't seem to be the case at the moment, right? And I'm not quite sure if we do get quite a big of a squeeze, let's say euro dollar down to 110 on big risk off. Perhaps the earnings will actually outpace that of the US from an upgrade and a downgrade perspective. But the problem will be that in the risk off, probably the Eurozone is still going to underperform because it's the most cyclical market. So the valuations won't help in that environment. But you're absolutely right in terms of input costs. I think what we do see, and that is a global phenomenon, is now is the time where really probably the higher input costs, higher, let's say higher prices paid, for example, from all the PMIs, that typically tends to have a lag from around 3 to 4 quarters with things like new orders, with things like earnings growth. So far, we didn't have to care because we haven't reached that time yet, where really the higher input costs will become a drag on margins, will become a drag on earnings growth. That time is really from around the turn of the year. And as you said, particularly in 2022, that's where a lot more fundamental headwinds will be coming up, contrary really to the last 12 months.
Max, what do I do then? You're basically suggesting I get defensive, I rotate into the States, I look for the defensiveness that maybe tech has to offer. Is tech going to hold up if we get a correction? Is tech going to hold up? Is tech going to be the place to be if I get a down of, say, 10% at an index level? Is tech going to bounce back first? I'm wondering if we are going to see the kind of volatility that a lot of people are talking about right now, where I want to be in that kind of environment. Is tech really that space?
So first, let me be clear. We don't expect that volatility to hit just yet. That is really something for, I think, around the turn of the year and for the beginning of 2022. It's premature to position for this just now. It really is a bit too early. Why? Because we still have, this sort of bad news is good news paradigm, that paradigm of, when there's more mixed activity data coming out, that really taking any sort of urgency away from the Fed to be uber hawkish. That means yields remain in check, and that means tech and growth and quality benefit. Now, in terms of volatility, when that comes around, perhaps around the turn of the year, perhaps in Q1 and particularly the first half of next year, I think it will depend. The risk is that we get a kind of environment where real yields will go up and break evens go down. In that environment, that from an asset allocation perspective is the worst environment because you can't really invest in anything. Really, where the only thing that is attractive is dollar then. So what you do, I think, is you look at a bit of dollar upside at the moment. You look at a couple of risk-on currencies where hedging costs are particularly cheap, and look at things like cable, for example, where vols are almost at the lowest since post-Brexit. So that's really where it's attractive, hedging against a sort of risk-off spike in the dollar in the next 6 months.
So if real yields wind up rising and break-evens fall, that's the projection. Where does that leave then central banks in terms of positioning like the ECB?
I think that's a risk, and that risk really for the ECB is more convergence with other central banks, perhaps other more hawkish central banks. Let's call it like the RBNZ, like the Bank of Canada. And I think what we've seen in bond yields lately, almost pricing in, a hike even in 2023, in the second half of 2023, and certainly fully pricing a hike in 2024. That was absolutely premature. So that is not justified. Goodness knows what's going to happen in the next 3 years. But the market fully positioning for a sort of good inflation outcome and fully pricing out any kind of downside risks to inflation for the Eurozone, that really does seem to be pretty early and pretty premature, considering where we've had it to in the last 7 years. So I'm not fully buying into that for the ECB in particular, being more divergence with other, perhaps a little bit more hawkish central banks globally.